Hi, welcome to Numeric's video blog, your expert source on derivative trends and topics. I'm your host, Jim Jockel. From Europe to Asia, it seems not a day goes by without news of another major central bank easing monetary policy or taking rates to zero. In fact, last week marked the 14th central bank to ease monetary policy so far this year. Taking a look at this graphic, specifically in the EU, you can see main policy rates in zero or negative territory represented in red, including Denmark, Norway, Sweden, Finland, Germany, France, Spain, Ireland, the UK, Italy, and Greece. As the currency war debates heats up, today I'd like to focus on Denmark and the recent pressure they've been under, specifically the likelihood of having the Danish National Bank follow the footsteps of the Swiss National Bank and abandon its peg to the euro. Joining me today to discuss this is Udi Sela, Vice President of the Numerics Client Solution Group and resident FX expert. Udi, how are you today?
Thank you. Very well, Jim. Thank you for having me.
And thank you for joining us. So why don't we just start, and perhaps you can provide us the latest on the situation.
Right. So everyone is probably aware of the surprising decision by the Swiss National Bank stopping the pegging of the Swiss franc to the euro at 120. They have been buying billions of euros against Swiss franc for 3 years since 2011. And on the 15th of January, they've decided they will change this policy and will not support the Swiss franc anymore. When I say support, basically weaken the Swiss franc. Because Switzerland, and we've seen that with the HSBC recently, the affair in Geneva, there's HSBC Bank in Geneva. Switzerland has always been a safe haven for funds, basically. And during the rough times, and specifically the quantitative easing of the Swiss National Bank has determined that it will be too costly for them to protect the Swiss franc, or if you like, to weaken the Swiss franc. And as a result, on one day, the Swiss franc has strengthened by almost 40%, which of course has created shockwaves across the industry. It was the biggest volatility ever experienced in the FX market since 1971 in one day. So basically, investors were looking for similar pegged European currencies and looking for a similar play. And the country that they chose was Denmark, because the Danish krone is pegged to the euro in a tight range of 2.25%, which is actually enforced in ranges of almost between 0.5% to 2%. So basically, what investors were doing is buying the Danish krone and hoping that the central bank will not be able to weaken the Danish krone. And indeed, we are seeing the central bank buying billions of euros against the krone for months. And even the central bank has announced that it's stopping its financing program and not issuing bonds till 2016. They cut the rates, the discount rate to minus 0.75%, pretty much aligning it with the interest rate in Switzerland. So we've seen, you mentioned negative rates. We actually saw negative rates of the 10-year government bonds in Switzerland trading at minus 30 basis points. And the Danish 10-year government bond traded at around zero. And as a similar effect, we've also seen corporate bonds issued at negative rates. So basically, investors pay money to pay interest to corporates for parking the money with them, which is unheard of. So that's pretty much the background, Jim.
Thank you, Udi. And we've seen some market participants come out saying that the unpegging to the euro is going to be very unlikely at this, however, time. Just this week, Fitch has come out and confirmed Denmark's currency issuer default rating at AAA with a stable outlook. But they did note that, however, monetary easing to defend a peg may not come without risks, namely the risk of negative valuation and sharp krone appreciation and buildup of credit risk in the financial system. So just turning towards option trading, what are some of the strategies that individuals in the FX market should be thinking about given this negative rate environment?
So that actually, I think there are two questions embedded in your question. The the first thing is how can one profit from or profit or even hedge against sudden unpegging of the currency. So, for instance, we read that the Citibank they showed on that day a loss of 150 million dollars from the unpegging of the Swiss franc. And what was interesting to know that they had options hedging the downside, which expired a week before the Swiss National Bank's decision. That's kind of shocking. And in a sense, we also proposed like two years ago a play in case of a euro breakup, buy options betting on the strengthening of the Danish krone. So you can do that just buying put options, put euro, call Danish krone, or you can just buy one touch option. So if the range of 2.25% is broken, which I think was something like 709 krones to euro, you can buy a one touch option if the market just moves to that level or beyond. These are like either hedges or investments betting on the breakup. Now, if you look at the negative rates, one of the things that we saw during the subprime crisis, and may come back again, is was people betting on CMS spread options, buying a spread, or buying a positive spread, or actually selling floor on the spread. So let's say if the short-term rate, let's say the 2-year rate is perhaps minus 50, and the 10-year is at 0 or minus 0.25, you can bet that the range between the range between the 10-year and the 2-year yield cannot go beyond, let's say, minus 0.5. And there is a market for that now. These are options which are very difficult to price, but people will make you price on them. So that could be an interesting play.
Well, Udi, thank you so much for shedding light on the topic. And of course, we look forward to discussing this again with you soon. On the Numerics video blog, our goal is to examine the risk management, derivatives, and regulatory topics that you want to talk about. Keep the conversation going on LinkedIn and on Twitter at NX Analytics. For up-to-date industry news, blogs, videos, research, and technical papers, follow us on LinkedIn or visit numerics.com. Thanks for joining.